Oliver, banks selling payment protection insurance, white goods retailers selling extended warranties. I hate companies which rely on people being forced to buy their stuff. So when I saw annuity providers in the UK yesterday seeing their shares tank because the UK budget no longer required people to buy annuities, I was quite happy. And, seeing the shares fall again today, even happier.
Well, I suspect you're not alone. There'll be certainly a lot of people approaching retirement who will also be quite happy to see what's happened. The UK budget yesterday said that people were no longer required to buy an annuity with their pension pots and they could just spend the money however they like, and that's awful for the annuity providers whose share prices have fallen heavily. And it does give people a lot of choice about what they do when they get to retirement. Being forced to buy an annuity has been extremely unpopular, particularly in the last few years when interest rates and hence annuity rates have been very low. People have said, well, why should I, if I have £100,000 in my pension pot, that only buys me about £3,500 a year of inflation-linked income. That's just a lousy deal. I don't want to buy an annuity. Now they've been told they don't have to, so celebrations all round.
Now, the likes of L&G and Standard Life and bigger insurers have not seen their shares fall as much, and indeed many recovered today. Why is that?
Well, the picture is slightly more complex for them because they're not pure play UK individual annuity providers. They've got a lot more. And of course, there's two things to remember. Firstly, the annuity market probably won't disappear entirely. There are some pretty extreme forecasts out there today. One broker says it might fall 90%. It might be less than that in countries such as the US, where there's no compulsion to buy an annuity. People still buy them. The advantage of an annuity is it gives you secure income for life. So there will still be some sort of an annuity market. And of course, if there's no annuities, yes, people might go and blow their entire pension pot on cruises, but more likely they'll spend some of the money on other kinds of financial products. And who's going to sell these financial products? Why, the life companies who used to sell the annuities. They'll develop a whole new range of potentially very high margin, potentially quite complex products to try to sell to people who want an alternative to annuities.
Do we think this is a good policy? Because ultimately these shares are now trading on a public policy shift, and the risk with annuities is kind of underestimating how your life expectancy really. What are the details there?
Well, yes. I think it's a good idea to change the policy. Forcing people to buy annuities isn't a good idea. But there is a huge risk, and I think the huge risk in financial education and enabling people to make good decisions. If you think about it 20 years ago or 30 years ago, pensions used to be down to your employer. Your employer would basically say to you, don't worry about it. When you retire, I'll make sure you have a nice income. And that was the deal. Now the message is very, very clearly, you're on your own. Your employer might put a little bit into your pension pot, but you've got to decide where to put that pension pot, how much you want to put into it, and what you do with it when you actually come to retire. And it's the individual against the entire financial services industry. Now you might see that as very stacked against the individual, so there could be some problems ahead.
Okay, well, speaking as a 27-year-old, I'm scared already. Thank you, Oliver.